Hey guys, today I'm going to cover 6 different methods for valuing real estate. The first method I'm going to talk about is called the cost approach, also known as the replacement cost approach because it's based on the question of asking how much would it cost to rebuild this structure from scratch. So think about that. This is probably the most practical method that we're going to cover because you're not looking at the income potential of the property, you're not comparing it to other properties, you're simply asking the question, how much would this structure cost to completely rebuild and start from scratch, including the land value? And that's a very precise number that you can figure out. This is a really useful method for figuring out the cost of properties, especially where traditional comps don't really do it justice. This is also a method that I use personally in my business, more so when I'm talking about my entire portfolio strategy. So when we sit down for the year and we're looking at our goals and we're trying to figure out if we're going to be focusing on the development side of the business or looking at acquiring existing structures, the big question that we ask ourselves is, can we acquire properties below replacement cost? And if we can't, then it might make more sense for us to go out and fill our pipeline up with development projects and build new projects because we can build them cheaper than we can buy them. The next one is one that a lot of people are going to be familiar with, and it's called the sales comparison approach, also known as the market approach. And this is something that you'll hear people say is when they're looking at comps. So this method hinges on comparing recently sold properties, looking at their sales price, looking at comparable properties in the market with similar attributes, and then trying to compare apples to apples in the market. It's a challenging method for several reasons, but really it's difficult to find similar enough properties and then discounting their differences. And also market forces are always shifting. So that's a challenge. Given the inherent challenges with this method, it really needs to be used in conjunction with several of the other methods that we're about to discuss. This next method is one of the most used methods for income producing properties, and it's called the income capitalization approach, or just the income approach. This approach weighs the expected income that an investor can generate against the current market cap rate. So to break this down, I'm going to go over the different parts of this formula and then give you an example. The formula looks like this. Value, the property value, equals net operating income, or NOI, divided by the current market cap rate. The net operating income, or NOI, is really simple. It's just the gross income minus the gross expenses. However, an important distinction here is that this is prior to any debt service. So not including any of your capital expenses, just the operational expenses. The second part of the equation is the market cap rate. And this is really going to impact your value, so you want to get this right. The market cap rate can be derived from other properties that have recently sold in the market. You can ask local brokers for this information, or you can find this information yourself with the right data resources. And to get the cap rate from the recently sold properties, we're just going to rearrange this formula to solve for cap rate. So now we're going to take the NOI and divide that by the property value, so the sale price of the recently sold properties. Once you do this process over and over again for several properties in a market, that's going to give you a pretty reliable cap rate. For example, let's take a property that's producing $140,000 in NOI, and similar properties in the area trading at a 7% cap rate. If you take the NOI and divide it by that 7% cap rate, you're going to get a valuation of $2 million. Next up, we have the gross rent multiplier, or GRM, and this is a simple but effective way to assess a property's value. It involves dividing the property's price by its gross annual income. For example, if a property costs $600,000 and generates $80,000 in annual income, you would have a GRM of 7.5. So this method is really used to identify properties that have a low price relative to their market-based income potential. Another method you'll often hear, especially in multifamily, is value per door. Again, this is a useful method to quickly compare properties to other properties in the market. For example, a building with 30 units priced at $6 million would have a value of $200,000 per door. Now, if that's a building you're considering buying and other properties are in the market are trading at $150,000 per door, you might want to negotiate your purchase price. Finally, we have cost per rentable square foot. And this is really similar to value per door, but it works where value per door doesn't make sense, such as if you're looking at a retail building. For example, if a building has 10,000 rentable square feet and the average cost to rent per square foot is $12, a purchase price of $1.7 million would generate a 7% annual yield. However, If you know that you can charge $14 per square foot instead of the 12, a valuation of $1.9 million would yield the same gross return. So valuing commercial real estate is as much of an art as it is a science. Any single one of these methods won't give you the entire picture, so you have to combine these methods in a way that can get you to the true valuation. Let me know in the comments if you guys found this information helpful, and I'd really appreciate if you can give me a thumbs up. Also, don't forget to subscribe if you'd like to learn more about real estate syndication in future videos.